Most traders fail. A lot of investors fail as well. And the primary reason that they do not succeed is that they're not managing their risk. Now, one simple rule of thumb is size your positions based on their inherent volatility with the goal of not having a drawdown greater than 1 or 2% of your total portfolio liquidity. The math behind that is assuming that you can look at a combination of realized and implied volatility for an instrument, determine where outside of that range it's moving too much in the wrong direction, place your stop under that percentage, and then calculate that loss such that it's not more than 1 to 2% of your position when sizing. Now that you've thought about doing that, you've given yourself a lot more chances to trade the market. What I've seen is many people tend to simply go all in and hope that this is going to be the one. It's sort of like putting it all on black. Don't be that person. If you're lucky, you'll actually be unlucky, as strange as this sounds. If you're lucky enough to win a concentrated bet, and it's not because of discipline or strategy, which it wouldn't sound like it would be in this scenario anyway, you may set yourself up for the other psychological folly of trading, which is the Midas touch folly. The idea that, hey, I'm so good at this, anything I touch goes up. So I'll just, sort of wing it and buy whatever I think I can buy. That'll go up because I got lucky. A lot of people that do that, they get that mentality and then they blow up. And that humbling is sometimes what helps folks to turn it around. I mean, a lot of folks on this journey blow a few accounts before they finally get their consistency down if they continue. It is a gauntlet. You should set your expectations realistically. You don't want to learn about the fourth shape. And it comes down to it, especially once you get past 20%. The math just becomes less and less forgiving for rebuilding that capital. And it's certainly not going to happen through a revenge trade. That's one of the worst things you can possibly do to yourself as a trader. When something doesn't go your way, the best thing you can possibly do is close out of that, look for other opportunities, and don't look in that rearview mirror. If it does what you thought it was going to do, maybe that just means you need to adjust your entry and risk management parameters. Like, for example, if you got stopped out because it went a little lower than you thought, maybe what you really needed is a smaller size position with a wider stop. Think about it. Journal your trading so that when you're reviewing your trades, ideally once a week on a Friday or over the weekend, you can go back and say, you know what? I would have been right if I had done a few things differently. And then you can look at how you might be able to change your system. It's not going to work for everything. Some things we're just going to get wrong. Some of the best traders only have like a 60% hit rate. But if those 60% hits are running and you're letting them win, and those losers are small and you're chopping them when it's appropriate to do so, you're going to be making good money. Taking ego out of the game is so important too. I can't tell you how many folks struggle with the idea of cutting risk at their stop rather than moving it lower. Because, there's this idea that, oh, but I'm right, and I don't want to admit I'm wrong, and by selling or closing this position, I'm admitting I'm wrong. That doesn't matter. Who cares if you're right or you're wrong? It's about making money. We're all going to be right and wrong in the market. Let's talk a little bit about my experience. I've been doing this since 2005. That dates me a little bit. 21 years of trading markets, of working with fund managers, of investing my own capital, of building trading tools. It's really been quite an exceptionally fun journey. I've learned a lot. I've met a lot of amazing people. And I'm fortunate enough to be in a position now where I can pay a lot of that forward. That's why I love doing these once a week streams. And I'm planning to add some more content that I'm going to be putting out there, both video and written. I've just launched a free Substack to share more of my insights about what's going on in the market. And I post a whole lot of content on social media as well. All of that is really to try to help my audience level up. I know there's a lot of noise out there. I try to focus on the signal. I suggest you do the same. There's only so many hours in the day. If you find there are bits of information that don't help you make informed trading decisions, take them off your charts, take them off your market prep, Take it out of your mind. Focus on the signal. That's one of the most important parts outside of risk management, is not getting analysis paralysis. If you've got too many lines on your chart, if you've got too many things you're monitoring, too many positions in your portfolio, et cetera, that can degrade your ability to execute. You've got to focus on what works for you. And that should also be part of your trading journal. How did you come to this decision? What did you analyze? What did you find was helpful and not helpful in review? Because we can all build a trading strategy, and we should. But if we don't practice it, if we don't adhere to it, if we don't actually build it over time through that idea of journaling and iteratively improving it, then the trading strategy might look really good in theory, but in practice, it could be total trash. That's why it's really important to, again, step aside from ego. Maybe the strategy's first draft wasn't that great. Maybe by the time it gets to its fifth iteration, it will be solid. The only way to know that is if we're willing to objectively assess strengths and weaknesses. So let's zoom out, looking at the big picture of what's going on in these markets. First, we're hearing about the Strait of Hormuz being effectively closed, and that means a fair amount of oil heading to various Asian destinations and parts of Europe is now being rerouted. It's not that it's blocked off, it's that it's taking a more expensive route, a longer route. That means that oil tankers are going to have much higher fees. It means that gets passed on to the end customer in higher oil prices and delayed shipments. This has put a premium, a geopolitical risk premium, on oil, which is bid up this morning as well. We've got Brent now above 80, 83.48. We've got West Texas Intermediate crude also bid up to 76.13. And what would an energy market rally be without natural gas up 5.81%? So you can see there is some of this bleeding into the energy markets over the last several days. Yesterday, oil had that big move higher, settled off its highs. Now we're actually breaking above yesterday's highs in both West Texas Intermediate and Brent. So there is a real bid behind this. And in terms of Iran's oil, who's the biggest buyer? It's China, similar to Venezuela's oil. Noticing a bit of a pattern here. Nevertheless, it's going to be important to watch how this situation resolves, because ultimately it's becoming more of a potential regional war that could last quite a while. That could have episodic effects on oil. It could have impacts on the regional economy. And of course, sadly, it is beneficial to a number of defense contractors in Israel and in the United States. But we're here to make money, and there's certainly a bid to be had in some of those plays. And some of the drone plays had a really big bid yesterday as well. That may continue if we see these tensions escalate. Now, shifting gears a little bit to liquidity. This is where we are right now in the SPX flow of funds. You can see we are in the liquidity low zone. That is to say, early March, these first 2 weeks tend to be tumultuous anyway. Take war out of the equation, take anything else out that are known risks, and it's just a time where the market tends to be more volatile, where you're more likely to see drawdowns, where you can break ranges to the downside, hint, hint, and where price discovery starts to get a little bit reinvigorated. And the reason is in two parts. For one, it is liquidity runs low, and then by mid-March, it starts to ramp right back up again. So this could provide a decent buying opportunity for swing trades and investments. It's a good time to make a shopping list when the markets are under pressure. The other part of it, and it's probably related, is the seasonality of volatility really improves here into mid-March as well. So you've got liquidity drying up, you've got volatility mechanically ratcheting higher, and that does set us up for some discounts, especially in some of the higher beta parts of the market. So I think it is a good time to make a shopping list. I think it's a little early to do too much buying, but I do like the idea of looking, and we'll go to the chart soon, but looking for a breakdown from this range we've been trading in as an opportunity to load up some equity longs, both here and abroad. Speaking of equity longs, this has actually been one of the most interesting times of dispersion. You've got stocks within the S&P trading with the least correlation to the index that we've seen since the great financial crisis. I just wrote an article about this on my Substack, talked about how this is a stock picker's market because of this. And it very much is. Now, whether this trend continues is a whole other matter altogether. But as long as this spread is elevated, you're going to have both a stock picker's market and a real hedge funds market. That is to say, the real long short strategies that are looking for buying relative strength and selling relative weakness can also do really well in this environment of elevated dispersion. In terms of relative strength and relative weakness, we can see it playing out on this chart from Goldman Sachs. Asset-heavy companies outperforming asset-light companies. That really does tell you value is outperforming growth. That's a big part of this because the asset-light companies are often the more tech-oriented companies, the ones with more intangible value built on things like intellectual property. The asset-heavy companies, they're going to be the ones that are more like your industrials, materials, miners, energy companies, et cetera. And certainly those have been outperforming, and that may continue. Meanwhile, in tech, we've seen a drawdown across positioning aggregates, which tells you we're no longer stretched long tech. That's a good thing, by the way, because that could also set us up for some opportunities to buy some of the heavyweights in tech. I'm still looking for more dips to add to my Google position. It's a big position, but I'd always like to own more at better prices, for example. Now, zooming out to the global picture, when tech underperforms globally, emerging markets tend to outperform globally. So we are in that potential handoff right now. We have seen tech underperforming since November of last year. Emerging markets have had a strong outperformance last year, and this year they've had one of their best starts to a year in 30 years. The momentum is there, the relative strength is there, and it could be set to continue. Another area of opportunity is cyclicals versus defensives. If you take Goldman's economic forecast, which is looking for GDP in excess of 2.5%, that suggests cyclicals should run versus defensives. So again, think about things like financials, energy, materials, industrials. There are signs that if the economy starts to climb back up out of that fourth quarter doldrum, we could see pretty significant outperformance in cyclicals, both here in the US and abroad. Now, the risk for emerging markets is actually playing out. This is that if the dollar appreciates, emerging markets suffer. If the dollar depreciates, emerging markets tend to rally pretty hard. We are seeing an appreciation in the dollar, which I'm looking for it to set us up an opportunity to buy some of these emerging markets at lower prices. And we'll talk about that on a later chart looking at the dollar technicals. But suffice it to say, I don't think that dollar strength is going to be a long-term phenomenon. When we're looking at this chart of global emerging markets relative to the United States market, we can see this might be just the beginning of a much bigger move. If it's anything like prior moves, we could have quite a bit of room for global emerging markets to outperform the US. And that's great. It would give us an opportunity to extract some value from places that are much more reasonably priced, where the valuations suggest the downside risks could be quite a bit lower. So I'm all for it. I'll take, momentum and the opportunity to make money in whatever asset class in whatever region it presents itself. And right now, the markets are very clearly telling us that's overseas. We just need to wait for the dollar strength to settle out. And finally, a quick note on AI. If you've been following my work, you know that I believe that over the last year, the narrative has switched from one of sheer scale to one of efficiency. That is to say, it's not about just having incredible amounts of compute to win the AI race. If it was, companies like XAI would have won the race because they have arguably some of the largest scale, and yet they have some of the least powerful models. On the other side of it, look at Google and what they've accomplished. Google has the whole AI hardware stack. They built the TPUs. Those are the compute units that inference runs on. They have their own inference engine. They have their own customized version of Linux that inference engine runs on top of their TPUs. And they build their own models. So Google has the whole AI hardware stack, which is one reason they've been able to extract so much revenue per gigawatt. I like this metric, by the way. I was never a fan of measuring compute by gigawatts because it's completely arbitrary. But the idea of showing revenue per gigawatt or operating profit per gigawatt or even compute per gigawatt, that adds a lot more value to that metric. And Google and Anthropic both leading on this chart in terms of sales and earnings respectively. Let's shift over, talk a little bit about the technicals. I can't say I love them, but I am happy about the idea of potentially being able to buy things at lower prices. So there's something to look forward to, silver lining, if you will. The S&P is showing vulnerability as it trades at the lower end of this range. In fact, it's breaking below the lower end of this range this morning. If it closes the week out like this, I think it's very likely we retest those November lows. That'll bring us down to about 65.25 on the S&P futures March contract. That would not be a bad place to start looking at adding risk, in my opinion. I do think that this market is wobbly here. We've got a pattern that looks very distributive over the last several months. So you can see underneath the surface, there's been this rotation into safer parts of the market, into some of the more asset heavy parts of the market. But it has been a rotation out of tech, and tech is such a large part of the weighting in these indices that they can't really run without it. Look at 2022, for example. The mega weight components of the indices really brought things down. There were other parts of the market like energy that were rallying. If you looked at the indices, you wouldn't know that because energy is an inconsequentially small part of the total index weighting. Well, we have a sort of similar situation happening here. It's not quite as drastic as 2022, but there certainly is a rotation out of tech. There's other parts of the market that are performing, but they can't really make up for that weakness in tech. And so it does feel like as long as tech is heavy, we do have that risk to the downside in the S&P and also, of course, in the NASDAQ, which could take us back to last summer's lows if we break the lower side of this range, which I think is increasingly likely. It's not just the geopolitical tensions. It's also the generative AI CapEx growth narrative, which is coming under some pressure. We heard on February 20th, OpenAI was downsizing their AI CapEx plan significantly. I would not be too surprised to see other companies go through similar discussions about how they may slow down their build. They may push out their goalposts to years ahead, or they may just slash CapEx spend. And by the way, that's not a bad thing. If we look at what's happening in AI overall, it is efficiency that is increasing. You're seeing smaller models being able to do more, like Alibaba's Qwen, a 9 billion parameter model that can hold its weight with GPT 120B, a 120 billion parameter model. It's a model that's like 93% smaller, and it's still pretty similarly capable. Obviously, we're comparing mixture of experts models with dense models. It's a variation in the architecture behind these large language models. But at the end of the day, if you can take a model that's about the size of putting it on a phone or an old video card and run with a level of inference quality that you couldn't previously achieve, that's a major milestone. And that progress continues to accelerate. So it's something to keep an eye on because it's no longer a race to scale. The new gold standard in AI is density of intelligence. Speaking of gold behaving with its upward trending channel here, once again getting to the top and being rejected. I think ultimately we're going to break out of this channel to the upside and start to build some new structure above it. But apparently it wasn't going to be this particular escalation that led us there. Now, it's also interesting to see gold and silver down so heavily this morning, given that geopolitical tensions are typically good for precious metals. But I suspect there is some deleveraging going on underneath the surface. That is to say, if you're leveraged in this market and you've got a bunch of different stuff that you can sell, you may just sell whatever you can. Gold and silver tend to be those things in the portfolio that when things get tough, when someone's tech positions are going against them or whatever else, they sell some of that as well. So I think there is some deleveraging going on in gold and silver as a part of why we're seeing some of this weakness. Silver is hanging in the balance here. If we do crack this lower trend line, then I think this whole upward move from December on is in big trouble. So it's going to be pretty important that we don't break back below this line. This is sort of the line in the sand for the silver bulls. And I know there's been a lot of talk about COMEX not being able to deliver inventory and all this other stuff. I've been hearing this talk for on and off 2 decades in the precious metals markets, and it doesn't typically, on its own, present a bull case. We need to see real industrial demand for silver, real precious metals demand for silver and gold to really bring them back to life. And gold looks a lot healthier compared to silver here. Gold's uptrend is completely fine. One of the things that I said going into Feb is I thought silver would underperform gold, and it would take some time to digest these gains, and eventually we would start to push higher, but it could take weeks or months. I'm still of that mind here, and if we break this lower trend line, we could go into a long-term consolidation pattern. Sort of shake out everyone, not just due to downside, but due to boredom. Bitcoin also looks quite vulnerable to me. In fact, I still wouldn't be surprised to see Bitcoin get back to about 52,787. The way it's trading, lower highs, lower lows, accepting these lower lows, gives me a sense that it's still heavy. Liquidity is also low in this market. Bitcoin is a relief valve for excess speculative liquidity. So this also gives me a sense that, we still have a lot to parse through in terms of what's going on with Bitcoin to try to put in any kind of durable low. We would need to see bank reserves build back up. We need to see reverse repos build back up. We need to see short-term and intermediate-term liquidity in the global financial system meaningfully build before crypto can catch much of a bid here. And here's the US dollar index. We've been talking about this chart for a long time, that we could probably get a little bit of a bounce here, that it would put pressure on precious metals, that it would put pressure on emerging markets, and that it could give us a bounce that surprises a lot of people, shakes people out of their positions, but ultimately presents a buying opportunity. Because I think the dollar can still ultimately resolve meaningfully lower because of accelerating de-dollarization trends, aggressive deficit spending, and some of the other things we're talking about and we've been seeing. The outlier is Warsh and what he actually does and what he actually means. Last night, I was reading some headlines about how he wants to do QE to a point to reduce the Fed's balance sheet down to pre-great financial crisis levels. It probably has the markets a little upset hearing that the next Fed chair wants to do a very aggressive quantitative tightening, because that would be pretty bad for almost all the assets out there. So we'll see if that comes to fruition. I don't think he's going to have that flexibility, because I don't think there's enough liquidity to drain the balance sheet much further than they have. In terms of this week's pivots, I've got this all on screen for you, and we can see we're pretty much below those pivots on everything. Yeah. Gold, silver, NASDAQ, S&P, we're below those pivots on everything. So we are in bearish territory. And that's for swing trades. It's also for intraday. Yesterday, we could see 6810.25 was a huge line in the sand. The market fought to hold it. We rallied back up, made a pretty decent rally off the lows, but today we're giving all that back and then some. Now let's quickly look at what's going on in the SPX options levels. You all are welcome to screenshot this and share it. This is from my SPX options visualizer. It goes through, looks at all of the options, the S&P 500 options chain, breaks that information out, and it is queryable via a Discord bot that I've created, but also can be mapped onto Bookmap, MotiveWave, and other charting software. And one thing I always like to say, no matter where you are in your investing or trading journey, no matter whether you're doing well or poorly here, it is all a cycle. Don't give up. Learn from your mistakes. We all pay a tuition to the market. It's up to us as students to learn the lessons being taught. If you're having a rough go right now, learn about why. Did you size up too much? Are you running leverage? Are you too aggressive in options positioning? Think about it. Don't just quit. Think about what didn't work out and why it didn't work out so you can do better in the future. That's the way.